Hi everyone, thanks for joining us again at PhillipCapital's Market Watch. I'm Shawn Sng, Credit Research Analyst from Phillip Securities Research. In this episode, I'll give a quick credit update on the Singapore fixed income market for the first quarter, followed by the current interest rate environment. Additionally, I'll discuss some ideas that fixed income investors could potentially consider moving into the second half of 2024. So, without further ado, let's begin. Previously, the sharp rise in interest rate caused significant volatility in bond prices and put additional pressures on financial health of corporations by increasing their borrowing costs. Mirroring the prosperity associated with the Year of the Dragon, the market for new bond issuances in Singapore has begun to recover. Singapore new bond issuances with size greater than 100 million have started to pick up, with 17 issuances coming in the first quarter of this year, contributing to approximately 5.36 billion raised. In contrast to the previous years, where banks dominated bond issuances due to strong earnings from high interest rates, this year we saw a healthy mixture of issuers including banks, property developers, and real estate investment trusts, or REITs in short. I know you may think, why did you say that issuances picked up this year while the first quarter of 2023 reflected a higher number? Well, indeed, the number of issuances picked up in the first quarter of 2024 with a total of 17 new issuances as compared to 12 in the same period of 2023. However, the total capital raised in the first quarter of 2023 was inflated due to the issuances from HSBC, specifically their 5.3% notes, which has an issue size of $1 billion. This significantly boosted the figures for that period. In the latest FOMC meeting, the Federal Reserve held its rate steady for the sixth consecutive time at a range of 5.25 to 5.5%, stating the economic activity are aligned with their dual mandate. However, because the inflation data points are still elevated, it is still not appropriate to discuss any rate cuts. On the screen, you can see that inflation generally has trended down from the all-time high of 9% in 2022. In the past 3 months, inflationary data pointers such as the Consumer Price Index (CPI) and Personal Consumption Expenditure (PCE) experienced a small uptick, with both core data coming in slightly above market expectations at 3.8 and 2.8% respectively in their latest March release. With inflation remaining persistently sticky, we should expect current interest rate level to hover for a while longer and bond yields to reflect similar. With that in mind, fixed income investors who are typically risk-averse often compare Singapore government treasury bills with our local bank's fixed deposit. On the screen is an overview of the differences in return between these two products for a similar duration. Thus, if you have spare cash and are looking for a relatively safe investment opportunities to park your excess fund, our government treasury bills would be a better option, as they still offer 0.5 to 1% higher than our local bank's fixed deposit. Building on an earlier point, recent inflation data shows it's proving more persistent than expected. As a result, interest rates are likely to stay high for a while longer. Inflation needs to fall consistently month over month for a sustained period. Only then would the Federal Reserve garner the confidence to consider lowering the current interest rate level. So what strategies should fixed income investors consider in this environment? Firstly, the yield curve is currently inverted, so investors looking for something relatively short-term with minimal risk can soak in the higher yield levels that our 6 months and 1 year treasury bills are still providing. It is important to note, however, that these are short-term investment and investors may encounter reinvestment risk if yields decrease when these bonds mature. Additionally, now could be a good time for investors to look at adding some durations to their fixed income portfolio. At this current juncture, issuers will have to issue at a higher coupon rate to entice investors to purchase their bonds instead of other high-yielding options available in the market. Thus, this not only presents opportunity for investors to lock in a higher rate that they are comfortable with, but also a possibility of capital appreciation when rates comes down in the following year. PhillipCapital offers the trading of sovereign and wholesale corporate bonds via our POEMS Mobile Tree app, which is available in the Apple App Store and the Google Play Store. Bond trading is also available on our POEMS web platform. If you are interested in revisiting what we have discussed today, we would like to invite you to join our PhillipCapital Bond Telegram community. Here, we post news, write-ups related to fixed income investment, and also let our investors know about the latest bond issuances in the market. If you have any other queries or interest regarding fixed income, you can also contact us through the email provided. That is all for this episode of PhillipCapital's Market Watch. If you find this video helpful, please like us and subscribe to our YouTube channel, and we hope to see you again.